Shibata-san, so thank you so much for inviting me to FINOLAB 2020. And I'm so sorry that I cannot be there. I was really looking forward to the cherry blossom in Tokyo. But as I think many of you will know, the coronavirus has hit Europe badly and all of our borders are closed. Our flights are cancelled. And I'm here at home talking to you from Poland. So arigato gozaimasu, and it would have been very nice to have actually met everybody there, hopefully next year. Some of you may know me. My name is Chris Skinner. I have written quite a lot of books about fintech and banking, and I also write a blog every day at thefinancer.com about fintech and banking. And I've been doing that for a long time, mainly because my passion is fintech and banking. Having said that, a long time ago, when I started blogging and writing, it wasn't fintech, it was just technology and finance. And it became merged about the beginning of the last decade, mainly because we were seeing so many companies with ideas and fresh new thinking, much of which came out of the global financial crisis. And it's interesting for me right now in that I think we will see a lot of fresh ideas and new thinking coming out of the coronavirus crisis around how to do payments, how to do money, how to deal with each other digitally and remotely, as is evidenced by this presentation, which, you know, a lot of people now are learning how to work from home, remote work, social distance, use video and communicate from points around Earth that are no longer physical connections, but they're digital connections. Most of you will know that I talk a lot about digital. I've written several books about digital banking, digital connectivity, and I have a new book coming out around actually how to do digital. But to begin with, I think we need to put things in context, which is the way in which the world has changed with fintech. In that fintech, as I say, emerged about 10 years ago, and actually was driven very much by cloud computing and the smartphone. The smartphone appeared in 2007. Cloud computing was also emerging back then. And the two of those have actually driven us to what today is called open banking and open finance, which is a world of APIs provided as downloads on the internet through cloud. And because of that opportunity, there's been a massive rise in companies that are exploiting that opportunity. There's around 12,000 startups or more around the world that are focusing upon fintech. And the funding of these companies is immense. $111 billion, doubled the previous year in 2018. Last year, 2019, it was still around the same numbers. In fact, it's slightly plateaued because a lot of that $111 billion in 2018 was driven by China and specifically by the funding round of Ant Financial Alipay, which was $14 billion. So we're not seeing these numbers double every year, but we have seen them double every year until 2019. And that's quite phenomenal. This amount of investment is fueling a major change to the way we think. And a lot of it's around peer-to-peer connectivity, which, as I say, is something that in the current climate is proving to be incredibly valuable because we can now connect directly one-on-one, whether we're sitting in an office in a home in Poland or a conference in Tokyo. Because of that connectivity and that change of thinking, there's many, many new companies that are growing very quickly. And I'm just picking a few of them as an example. Many of these are close to my heart over here in Europe, but in Asia and Japan, worldwide, we're seeing massive changes. In Europe, one of the biggest changes is with companies like Monzo, a challenger bank. And even the idea of a challenger bank 10 years ago would have been stupid, but today is accepted because there are many of them in every country and more every day. And one of the things that a lot of traditional banks say about challenger banks like Monzo is that they're not real banks because they don't get the customer's salary check paid in every month. That's rather silly because Monzo is a lifestyle bank. It's not anything like traditional banking. And what's actually happening is we're seeing this dichotomy between traditional banking that gets the salary payment, and that salary payment goes to paying boring old bills like the mortgage and the electricity. And then Monzo gets the lifestyle banking of what we do daily in our lives, cashing the subway, paying for the Starbucks coffee, going for lunch. So Monzo knows our life and our lifestyle, and the old bank knows our boring old bills and our boring old way of doing things. And that dichotomy is growing in every economy because when we're seeing the emerging new banks, the reason why people like them so much is that they are doing great analytics around our lifestyle. And the more analytics they do around our daily life, the more we use them in our daily life. That's a fundamental switch. Another change is a company like TransferWise, who I didn't really understand until I had to make more and more payments overseas. I moved to Poland 2 years ago, and I discovered it was very difficult to make payments here from my bank account. But from TransferWise, it's real time, and it informs me in real time about what's happening with my account. So by way of example, I recently had to get my car fixed in Warsaw, in Poland, and the bill was for more than I had on my TransferWise debit card. And literally, as I sat in the reception of the repair shop, I moved $1,000 to my card and paid within a few minutes. That real-time connectivity is another major factor driving the new world of financial services. We also have people like Vitalik Buterin creating technologies that are dramatically transforming financial services. You probably all now know about Ethereum. You may have different views about blockchain, distributed ledger technology, but whatever your view is, it is still a critical technology for the future of commerce and transactions and governance because it enables us to create shared databases that are completely trustworthy. And we never had that before. And because we have that ability using technology, we don't need to have a central authority managing a central database. We can have decentralized structures. The difficulty with distributed ledger technology is that it's a very controversial technology, not because of the technology itself, but because of its use cases, which are predominantly in areas that are very difficult and are not areas that require technological solutions, but they require standards and agreements between counterparties. So a great example is one of the best use cases for blockchain is in digital identity. But digital identity is very difficult because you have to have an agreement between a government and industry and financial institutions to use that digital identity. And that's very difficult. So with the areas where distributed ledger technology and blockchain will have the greatest breakthroughs are in areas like clearing and settlement and digital identity. But to implement those areas requires a lot of agreements and harmonization and standards between counterparties, which is why it's taking so long. But the reason I pick on Vitalik Buterin is that he was 19 years old when he wrote the Ethereum code. And this is a critical factor for me, which is that children are inventing the new structures of finance. It's even better illustrated by this young lady from Thailand who is running a currency, the Kidlet coin, which is actually a blockchain cryptocurrency to educate children on money. But when Tanya created the company, she was 9 years old. Admittedly, it helps that her mother is heavily involved in distributed ledger and blockchain. But what I'm getting at is that no matter who you are and what age, you could be 9 or 90 years old, using APIs and cloud and today's technologies, you can create a new way of thinking about finance and creating new ways of doing finance. We're seeing this happening worldwide. And a lot of it coming from very young people, 19 years old, 9 years old, or Nikolai Solonsky, who's the founder of Revolut, who's in his 30s. One of the interesting things about Revolut, for example, which is the largest unicorn in Europe, just valued recently at $5.5 billion, is that it came out of disillusionment with the traditional financial markets. Nicholas worked for Lehman Brothers in September 2008 and obviously lost his job. But he is a former financial markets authority. He has that experience. He knows how financial markets work. There are many, many people who are creating new APIs, cloud-based services, apps, analytics, who have been around financial services in their early 20s and 30s and now are recreating financial services using technology. But my favorite fintech company is Stripe. And the reason it's my favorite one is because it is the biggest fintech unicorn in the world, but also because it was created by these two brothers, John and Patrick Collinson, when they were 19 and 21 years old. As I said earlier, teenagers, children are recreating financial services using code. And this is a critical factor, that it's not traditional financial people who are recreating and have vision around finance. It's kids. In particular, John and Patrick Collinson had this idea that it was very difficult to do checkout online. So they launched 7 lines of code in 2011 as an API to make it simple to do online checkout. And by 2016, their 7 lines of code were worth $9.2 billion. That's just in 5 years. 5 years. 7 lines of code worth $9.2 billion. What's even more amazing is that a couple of years later, the next valuation is $20 billion after 7 years, $35 billion after 8 years. Fintech is changing the game. It's a radical change with technology based around cloud and the smartphone and open banking APIs. This creates a big, big, big challenge for traditional financial firms. To put it in context, Stripe in September 2019 is worth more than 7 commerce banks, one of the biggest banks in Germany. It's worth more than 2.5 Deutsche Banks, one of the biggest banks in the world. It's worth more than BBVA, one of the most innovative fintech banks in the world. It's worth almost as much as ING, one of the most innovative global banks using technology. And this, to me, brings home a lot of what's changing, that it's actually about new companies doing new innovative things and changing the game. Banks are responding to this changing of the game. You know, if you take Barclays Bank and Jess Daly here, who runs Barclays Bank, they're not hanging around. They're not just saying, oh, let fintech take over. Yeah, Barclays Bank is worth less than Stripe. But it changed. And in 2 years, it increased its value by 1/3, but decreased its staff by 1/3. And this is a trend I think we'll see in a lot of institutions, traditional financial institutions going forward, that they're going to change and reduce their numbers dramatically by automating everything they can, using market data analytics, artificial intelligence, machine learning, reducing branch footprint, reducing physical footprint. They will become technology companies. They will become fintechs. We're seeing this already significantly in many of the large financial firms, but you can see the dramatic difference here between the traditional institutions and the digital institutions. Digital financial firms have huge amounts of value from a small number of people. Traditional financial firms have huge amounts of value from a large number of people. And to make this change, companies like JP Morgan are investing massive amounts of money in technology to make transformation happen. $11 billion a year. In fact, this is rising every year. And a lot of that is going into engineers. So 1 in 5 people who work for JP Morgan Chase today are in technology. They have more technologists than Facebook and Twitter combined. And this is because they want to be the disruptor and not the disrupted. How rapidly a bank makes that change is the challenge. How quickly can a large bank change from being a physical infrastructure to being a digital platform? This is the radical change and crisis in many companies that we're going through, which is how can we quickly make things different? In JP Morgan's Chase, they're doing amazing things with technology. Are they changing fast enough? It's a good question. And the reason I say it's a good question is that a big bank like JP Morgan tries to do everything everywhere, all around the world on their own. And yet today's world is one about partnering between new companies and old companies. When I talk about fintech, I kind of see it as being like the marriage of a parent and a child. You know, parent and child don't get married, but it's this partnering between parent and child. The child are these fintech companies run by teenagers with vision who can code. They have amazing ideas, but they have no idea why banks are structured the way they're structured or why financial markets work the way they work. The parent understands compliance, regulation, audit, the whole reason why we have financial markets structured the way that we're structured. But they don't have that vision and drive and innovation around technology. How do we bring these two together? The parent who wants everything stable and secure, and the child who wants to change everything and make it all different. I think Deutsche Bank, articulated this very well recently. They said in their strategy around their future that finance is what they do, but technology is how they do it. And equally, we're seeing this evolution of finance and technology. You know, a decade ago, a lot of it was around banks being dinosaurs. They would be disrupted and destroyed by technology. Then it became banks saying, we want to support innovation and creating innovation hackathons and workshops. But a lot of it was just corporate theater, you know, it's jazz hands. It wasn't actually bringing it into their organization. Today, we're seeing a lot of people talking about co-creation, collaboration, partnering between startups and traditional financial institutions. And over the next few years, we'll see the integration of these startups with these financial institutions, such that eventually by the end of this decade, we won't talk about fintech. We'll just talk about finance that runs on technology, which will be all banks, all asset managers, all fund managers, all insurance companies. Everyone will just run on technology. It'll just be finance on technology. So I talked a lot about the impact of the new startup companies and the way in which they think, and the fact that they have a huge amount of vision and drive from kids who can code, who think differently, who don't understand why banks and financial firms work the way they work, but they've seized the opportunity of cloud and open banking, APIs, analytics to change financial services and come up with radically different new ideas. How does the bank respond? I got fed up with people saying that banks would be destroyed and disrupted by technology. Banks are very challenged by technology, but they're not going to be destroyed by technology. We've had that discussion for a long time. It is not going to happen. And as I say, banks now are integrating and collaborating with new technologies to integrate those into their structures and become something different, to become digital banks. And I spent the last couple of years traveling around the world, meeting with banks and talking to them in depth about how they're doing their own digital transformation, which is incredibly hard because a bank is based around a physical structure. You know, most banks were created 100 or 200 years ago to distribute paper through a physical localized network of branches with humans. And now we're talking about digital distribution of data through software and servers. It's a completely different business model. It's a completely different way of doing things. And again, if you have heard me present before, you'll know what I mean about those things. But I picked 5 banks of the top 50 that I felt were doing digital really well. And these 5 banks were JP Morgan Chase, DBS, BBVA, China Merchants Bank, and ING. And I have a new book just coming out in the next month, which is all about doing digital. And what I wanted to do is to, first of all, meet banks I thought were doing digital well, such as these 5 banks, interview them, talk to them in depth, understand what and how they're doing in digital transformation, and then combine that with my own experience of doing this for decades to really identify the lessons we could all learn from these leaders around how to do digital transformation. So I spent a long time interviewing them, and all the interviews were recorded. The interviews are not reproduced in the books verbatim. There's quotations from each of these 5 banks around what I feel is relevant. But what I did find is that I got around 30 or more lessons that they have implemented that I could identify from those interviews based on my own experiences, and I share those in the book. And these 30 lessons are not a B, C, or 1, 2, 3 of doing digital transformation, but it's actually a guide to the things you have to bear in mind when you're trying to change your bank to be a digital bank, working with collaborative and open partnerships with the fintech community. And these 30 or more lessons ended up falling into 4 big buckets: what to do, how to do it, do it better forever. It sounds easy. It's not. Working out what to do could take maybe 2 years. Working out how to do it maybe takes another 2 years. Actually doing it takes 3 or 4 years. And then doing it better is forever. So we're talking about a 10-year cycle of change, a decade of change in just these 4 phases in this one slide. And one of the comments that was made by one of my interviewees really hit home, which was that the previous chief executive and chairman knew the bank had to change to be digital, but they didn't know what to do or how to do it. And the reason that strikes home hard for me is I have a quote that I've used for many years from Charles Darwin about the origin of species. It is not the strongest of the species that survives, nor the most intelligent. It is the one that is most adaptable to change. So it's not the survival of the fittest, the strongest, the fastest, the most intelligent. It's the survival of the ones that adapt to change the best. But if you don't know what to change or how to change, then you will not survive. It's all well and good changing, but are you changing in the right way, in the right direction? Are you doing the right things? And what's interesting for these 5 banks that I interviewed is that the first thing they began with is to try and work out what to change. And so they identified the digital leaders that they respected the most: the Teslas, the Netflixes, the Spotifys, the Pingans, the Badus, the Alibabas. And they went and visited with them all. And they went to find out, how do you do what you do? How do you structure? How do you manage your people? How do you communicate? How do you deal with rewards and remuneration? It's not rocket science. It's very, very much that these organizations, because they were born on the internet, are completely different. They were born digital. They didn't have the physical legacy. They still have to adapt to change all the time to embrace the mobile revolution, but they do things differently. A good example of doing things differently is that they organize in a radically different way. For example, with Amazon, they organize around 2 pizza teams. And that's the whole spirit of agile and flat organizations, that you have a team that's organized around being small. If it needs to have more than 2 pizzas delivered to this team for lunch, the team is too big. That's the idea of the 2 pizza team. And that's how Amazon thinks. In fact, it was quite funny that one of the banks said to me, every time they make a decision now, they always go, what would Jeff do? And I said, who's Jeff? And they said, Jeff Bezos. What would Amazon do? What would Alibaba do? every time that it comes up with the need to change the organization to do something differently. So working out what to do is to actually benchmark the people who you respect the most as digital leaders, and then work out how to internalize that to your own organization. Internalizing it is not easy. It needs a board mandate. And this board mandate is incredibly important. Again, I didn't realize this till it was in one of the conversations with the chief executive of one of the banks, who said to me that the chairman and chief executive were told to focus upon the digital transformation and not on business as usual. Forget shareholder return, forget profit, forget the metrics that you dealt with in the past, focus on the change. And this was incredibly important because when you're dealing with transformation, you can't do business as usual. You need to delegate that, let others deal with that. The board said, we will deal with the shareholders, we will deal with any issues with business as usual. You focus on business as unusual, make transformation happen. And that mandate was very important for the leaders of the bank to focus on change. And the big thing to do with change is if you have 25,000, 250,000 people in the institution, how do you fire them up to do things differently? Well, first of all, you need to have a burning platform. You need to make them wake up and worry about the fact that things are going to be different. In every institution, they had this burning platform. They had a moment where the chief executive and chairman announced things were no longer going to be the way they were. But equally, you can't give people worry. You can't just say things are going to change, you have to change, without giving somewhere to change to work out where we have to go. So you have to have that vision and communication of that vision around how people need to change and where they need to go. And this is another incredibly important part of communication, that there was very strong communication of how the bank needed to change, not just why it had to change. Everything about the way forward was focused upon customer. In all 5 banks, customer obsession was something that came through vividly and strongly in every interview, and you'll see that in the book. I think this is an incredibly important thing, which is that most banks traditionally have been focused around pushing products through channels to customers. The new banks focus on engaging customers digitally who want to be part of their platform via their technology and relationships digitally. It's a very different way of thinking. So it all starts with the customer journey. How does the customer feel? How are we interacting with the customer? Do we actually give them an experience? And more than that, do we actually understand how they think? So these are all the phases of designing the new bank, from learning what to do from digital leaders who you've benchmarked and met, to working out how to internalize that and deliver that within your own institution. Doing it is then the next piece. And this takes an awful lot of work, because changing the organization, the hardest part is changing the people. And all of these companies spend a long time working on how to get their people to be part of the change. The biggest resistance to change is in the middle. The people in the middle of the organization are the ones who feel most threatened by digital transformation. They think they're going to lose their jobs, they're going to lose their power base, they're going to lose their promotions, they're going to lose their career. They really, really don't want things to change. So how do you get them to engage and how do you get them to change is probably the most challenging piece of the implementation phase of doing digital transformation. But really, it's all about communication, engagement, support, participation, and offering the chance for people to reskill. You can't just say to a branch manager of a traditional bank structure that there will no longer be physical distribution structures that you're part of if you don't offer them a chance to reskill to become coders, for example, to learn Python, to get involved in innovation teams, to get involved in new agile structures. And in fact, it's quite interesting that all of these institutions are based around agile, which a lot of us talk about, but do we really do agile? It amazed me how often I'd meet teams where the audit and compliance and regulatory and credit and risk teams are engaged in ideation with designers and developers. So these small two-pizza teams would have these risk compliance and credit people sitting side by side with designers and developers, doing ideas around how to create new experiences for customers, everything based on customer journey and customer experience. And what that really demands is a very different organizational structure. I call it the synchronized swimming structure, which is that you have all these teams that need synchronization. How do you synchronize lots and lots of small two-pizza teams? And what that really comes down to is communication. One of the key things about all of these banks is they're flattening their structures. ING maybe described it the best. They said that they have 30,000 people that 10 years ago were 30,000 individuals, but now are 3,000 10-people teams. And those 3,000 10-people teams can get to the chief executive that day if they need to get a decision that day. The communication between the teams and the management is immediate and real time. You cannot have monthly reviews and decision making. It has to be same day. And that's a critical part of how these organizations work. Their decision making is immediate. One of the companies I deal with, a fintech startup actually, said to me that they did a deal with Alibaba and Financial to support Alipay in Europe. And from the first communication to implementation took less than 6 months, which is about the time that it had taken him historically to try and get a meeting with a bank senior vice president. You can't have 6-month, 12-month cycles of decision-making and communication. It has to be real time. And in fact, one of the key things about all of these institutions is that their management metrics and benchmarks are run in real time on dashboards. Every manager in every company I met is making decisions based on real time communication globally with every individual in the institution. The CEO of BBVA can drill down to exactly how a person is performing in an office in Mexico now in real time. You can't have decisions made on past performance reported in annual documents. It has to be immediate. So Digital Bank runs on a digital dashboard in a real-time digital connected world. And it takes, as I say, years to get to this stage of implementation. And then once you've done all of that, you can't just leave it there. You have to continue. You have to do it better forever. I love this comment from DBS, which is data is air. A lot of people talk about data is oil. Oil is a fossil fuel. It's limited. It's running out. It's scarce. Air is all around us. We need it to breathe, but we need clean air to breathe. If you have dirty air, you'll die. If you have polluted air, you'll die. Data is air. And the bank that can run effectively in an open banking world with APIs and apps and analytics from partners in the fintech community will have clean data that's consolidated, rationalized, and gives an enterprise view of everything that's happening in real time. That is the only way for a financial firm to survive from today onwards, to have good, clean data, good, clean air. And that's why you have to do this better forever, because if your data is locked into a system that starts to rot, then you die. And that's the real issue around most banks, that they've let their data rot in old systems. You have to get the data clean and fresh. Do it better forever. So these are the four massive phases that the big banks are going through to become digital banks and to be able to work in open banking with the fintech community. We're seeing a radical change in this world, and I think we'll see even more radical changes in the next decade. The fact that I'm presenting here to you from my home office in Poland is something that might become standard. It's certainly going to change the way we think about relationships. We will still be globally connected, but we may not globally travel. We will certainly move away from cash and from physical paper structures because they carry germs. One of my big issues right now is when I go to any shop here, they want me to use a PIN pad, which I'm worried it has coronavirus. We have to move to biometric payments, smile to pay. Lots of changes, even bigger changes in the next decade than we've seen in the last decade. Bearing in mind that the last decade has seen over 12,000 new companies start up new ideas in using technology with finance, radically changing the way in which banks do their own thing. I'm really pleased to have been able to present to you this morning from my remote office over here. I'm so disappointed that I'm not with you face to face, but I'm fairly sure the world will change pretty soon and we'll all be back together again in the not too distant future. Thank you very much.